Hello Baker Finance students. We are now in week 6, so after the end of this week we will be 3/4 of the way done with the course, and I know that we'll have the Thanksgiving break after week 7, but just keep moving along. You all are doing great. Enjoyed reading the forum discussions, and I'm looking forward to reading your EAC papers this weekend, or this coming week. But in terms of this week, we have 2 brief chapters, chapters 14 and 15. You're also going to have an interesting forum discussion about the future of cars. There's a pretty heavy investment by Toyota to look at some futuristic things with cars. And when I was in Portland this weekend, I loved their link system in mass transportation, but they also had a lot of these Go cars on the street. And if you're no longer a member of one, it was kind of like a device that you could put up to the car, and it would unlock the door, and then he would just be charged to your account, and you could drive around town. And a lot of people out there, especially live in the cities, don't need cars. So, but anyway, read the article and listen to the podcast on NPR, and then give your thoughts about whether it was a good decision by Toyota to invest in this new technology, and just what do you see for the futures of cars. So, and then also, have your readings and your homework from the previous week's chapter. So, well, with this week, chapter 14, what you're going to do is kind of go through a lot of the definitional and characteristics of different types of capital, whether it be stock, debt, preferred equity or preferred stock. And they also give a lot more details into the different types of debt. When I was working at Sprint Corporation, I would issue a lot of commercial paper. It was a short-term debt instrument that matured in 270 days or less and wasn't regulated by the SEC, but I had to have backup lines of credit to issue it. And I know at one point we had made the decision to swap out a lot of that short-term debt and issue some long-term debt. So there were a lot of bonds that we issued. So that way we were a little more relaxed each week. So I wasn't stressing so much that how am I going to come up with another $200 million the next day. That kind of puts a lot of pressure on the cash manager to try to always scrounge and find cash out in the market every day. So, but it was a financing decision, and that's what this first chapter is about. How do you want to finance your company? What does the capital structure look like? How much debt, how much equity, how much preferred equity do we have out there? What type of different debt instruments? So, this chapter is going to review a lot of the different details about these types of securities. And then the next chapter, chapter 15, kind of actually deals with the process of issuing new securities. Whether it's going to be new debt, new equity, or what we call stock, or other types of potential hybrid type of instruments. So there's obviously benefits from issuing debt. As we know, there is the interest tax deduction, but there's also limitations of how much debt a firm can take on. And a lot of times the market will tell you, Moody's, S&P will grade you on your debt, give you a debt rating. So it's unrealistic to think that a firm can just take on excessive amount of debt. Because again, idea in theory, if you could finance with debt, that can lower your weighted average cost of capital and give positive return on projects a lot quicker. But also there's financial distress from taking a lot of debt too. So in general, internally generated funds are the cheapest way to go when raising new capital, but many firms that are growing, trying to rely on just internally generated funds is not going to work. You're going to have to go out and figure out some way to raise more capital. Most likely, a lot of firms that are doing well, they may decide to go public. That's in the IPO process. And generally, you're hiring a Wall Street firm that is going to charge, what we call flotation costs, the difference between the spread and legal fees and the registration with the SEC. So when the firm goes public, ideally, in theory, the firm wants to try to get the biggest price that it can, and the Wall Street firm is going to try to do all their due diligence to figure out what is the right price to price it in the market. They're going to look at the company, interview management, look at the potential future cash flows, and come up with a price that they think they could sell it at, and there'll be demand for it in the market. So, because once it's issued, and if it's a best efforts basis versus a guaranteed basis, that's what the company gets. And if it goes up in price in the secondary market, well, the company doesn't get that, but the shareholder gets the benefit of the capital appreciation and the stock value. So you want to try to get the most you can when you do that issue. And not all IPOs go up in value. Some do actually go down, but it's you typically, the Wall Street firms will price in that they hope there will be some gain and there'll be demand there, that there'll be value so they can find buyers for that particular stock. So, okay, well that was it for this week. I'm going to keep it brief. But if you do have any questions, do send me an email or post something in Moodle. But again, jump into that forum discussion early this week. Try to get things done early. That way you can enjoy your weekend a little bit. And if you do have any questions, again, email me. But looking forward to talking to you online. So have a great week and talk to you later. Take care.